Welcome, everyone, to a brand new explainer on the Gap Advisors Ind AS Clinic YouTube channel. I am so incredibly thrilled to have you all here today. We're going to unpack a really fascinating real-world accounting case study. And honestly, it perfectly demonstrates what happens when old habits just kind of sneak their way into modern financial reporting. Specifically, we'll be looking at Ind AS 19, employee benefits, and we'll see how a seemingly harmless copy-paste from past standards can completely distort a company's financial narrative. So let's just get right into it. Real quick, before we get into the weeds, let's lay down a few ground rules so we're all on the exact same page. Just keep in mind, the views expressed in this explainer are entirely personal and they aren't binding on anyone. You should absolutely seek the help of a qualified expert before taking or, refraining from any action based on what we discussed today. For our analysis, we're assuming the functional and presentation currency is the Indian rupee, so any other currency is foreign currency. And our standard reporting period runs right from the beginning of the year on April 1st all the way to March 31st. Okay, let's move on. What makes today's observations so incredibly interesting is where it came from. This is not some textbook hypothetical. This comes directly from a suo motu, or independent, review by Gap Advisors of a real, published, listed company's financial statements. It's a huge wake-up call, right? If you happen to invest in listed companies, reviewing their financials for strict Ind AS compliance can literally make or break your decision to buy, hold, or sell those shares. And for the auditors tuning in, this is exactly why getting those financials reviewed by Gap Advisors before you sign off is absolutely critical to catch these blind spots. All right, to truly understand the error this company made, we first need to define what we're actually dealing with. So what is past service cost? In plain terms, it's the change in the present value of the defined benefit obligation for employee service in prior periods, which results from a plan amendment or curtailment. Think about it like this. If you retroactively upgrade your employees' pension benefits today for the hard work they did over the last 5 years, boom, you've just created a past service cost. Getting this definition locked down is totally key to seeing where things went sideways. Okay, now I want you to listen closely to this exact accounting policy on defined benefit plans that this listed company published in their financials. They stated that they, quote, recognize past service cost as an expense on a straight-line basis over the average period until the benefits become vested. Now, if you're well-versed in current Ind AS reporting, alarm bells should be ringing in your head right about now. This policy is literally a ghost from the past that's still hunting their current books. What we have here is a classic battle of old habit versus current rule. Under the old Indian Gap, specifically paragraph 94 of Accounting Standard 15, a company actually was allowed to recognize past service cost on a straight-line basis over the vesting period. But under Ind AS 19, that old rule is gone, completely gone. Ind AS 19 requires you to recognize past service cost immediately when the plan amendment or curtailment happens. Basically, this company just rolled their old AS 15 policy right into their Ind AS reporting and completely missed the memo on the updated mandate. The final nail in the coffin for this old habit is paragraph 103 of Ind AS 19, employee benefits. This is the definitive rule that they missed. Paragraph 103 explicitly says an entity shall recognize past service cost as an expense at the earlier of two dates, either when the plan amendment or curtailment occurs or when the entity recognizes related restructuring costs or termination benefits. Notice something. There is absolutely zero mention of a straight-line basis over a vesting period. None. The expense hit has to be immediate. So let's talk about the real-world impact. How does this error actually play out for that April 1st to March 31st reporting period? Well, when a company incorrectly applies the old AS 15, they're spreading that expense out over several years. And what does that do? It artificially inflates their short-term profit. But Ind AS 19 demands immediate recognition to ensure liabilities are accurate and transparent. So this isn't just some minor technicality, folks. It directly skews investor perception and messes with the integrity of the profit and loss statement. So the big question is, how do you prevent your company or your clients from falling into these old gap traps? You really need the right tools to protect your financial statements. The issue repository on gapadvisors.com is a total game changer here. It hosts over 4,500 resolved issues and responses on Indian accounting standards and Indian Gap. Anyone can register for free. You can submit your issues and get a detailed response delivered directly to your inbox, which is an absolute lifesaver for auditors needing to document how they addressed specific Ind AS applications. And hey, you can submit your financials in a near-to-publishing PDF format to info@gapadvisors.com to get them reviewed before you sign. Fun fact, if you want to trace a specific observation back to its source, it was actually featured in the 197th edition of the Gap Advisors Task Weekly newsletter. It's authored by C.A. Manish C. Iyer, director at Gap Advisors. There are over 230 editions published to date, and honestly, if you're on LinkedIn, you should definitely subscribe to it for free. It's fantastic. Also, if you find yourself stuck on a really tricky Ind AS or IFRS issue, you can easily book a one-on-one consultation with the author directly through his page on topmate.io. To make sure you never miss out, you should definitely follow the Gap Advisors Ind AS Clinic channel on WhatsApp. You'll get instant updates on all our new videos, podcasts, newsletters, recently responded issues, and newly issued standards. Plus, if this explainer sparked your curiosity, I highly recommend tuning into the Gap Advisors Ind AS Clinic podcast. It's streaming right now on Spotify, Amazon, and YouTube, and it goes into a massive deep dive on the exact observation we just tackled today. I'll leave you with this one provocative thought. If a major listed company missed this crucial update to Ind AS 19, what hidden old GAAP habits might currently be lurking in your own financial statements? It is absolutely worth investigating. Thank you so much for your time today. If you found this explainer helpful, please drop a like, add your thoughts in the comments, and subscribe to the Gap Advisors Ind AS Clinic channel if you haven't already. And please share this among your contacts, colleagues, audit and finance teams, and especially with students pursuing their CA course. Let's spread the knowledge of Indian accounting standards together. Keep learning, and I'll catch you in the next one.